Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back. Nice to have you with us. Thanks for tuning in to our Real Estate 360 program, your number one source for all of your real estate needs and education. We're broadcasting from the number one business radio station in San Francisco Bay Area, KDOW-AM 1220, the Wall Street Business Network. I'm Tom Wilson, your host for the Wednesday edition of Real Estate 360 that comes to you daily, Monday through Friday, with my co-hosts, Joe Kuchera and Laurie Graymont. So do tune in every day or go to our podcast for our daily shows on different aspects of real estate and real estate investing, real estate lending, so forth. If you can't make the live show, you can catch our podcast on RE360radio.com. And my programs also on TomWilsonProperties.com or on iTunes. And by the way, if you would like to get a weekly economic update, you can go to TomWilsonProperties.com and click on the dialog box there that signs you up, and you get a weekly 1-minute read on what's going on in the world of economics as it applies to real estate. So it's a nice way to get a summary without trying to digest the gobs of information that are out there that's so hard to work through these days. We also, you can go on there and get that same website and get lots of information on real estate investing. We have back with us today Richard Crouch, who is a frequent guest on our program, because Richard is a realtor with Alon Pinnell Realtors and a investment advisor with Transamerica Financial Advisors. And like myself, he was a entrepreneur in high tech here in Silicon Valley for many years, and then moved over to the real estate world. He's an agent, financial advisor, investor, and why you like having Richard on periodically, because he applies his entrepreneurial and engineering analytical mind to track the markets and help us decipher and wade through all the information that's out there and try to make some sense out of it. So, Richard, welcome back. Nice to have you back always.
Thanks, Tom. It's great to be here.
Well, this is continues to be a dynamic world that we're in, and people, it's a shame. Many people kind of live in fear because it's dynamic, and they get themselves in trouble through inaction. And I think one of the things we like to do on this program is to inform people, and I think the more educated people are, the more comfortable they can feel in making assessments and maybe reduce the risk or perception of risk that sometimes people have, which is greater than it really is. And certainly with this dynamic activity we're having, some people were talking about things slowing a little bit. Well, shoot, it's like when you slow a bullet train, it's still going pretty fast. So it's still a pretty dynamic world out there, isn't it?
It is, and today we have a number of things to talk about. The summer has its normal trends, and we've had those. This type of market we've been in has been pretty unique, but there's some other things that are really I like what you just said about trying to help people make decisions to move forward and not just do nothing in indecision. And that's a tough thing. It's a tough thing for anybody. Let me just say that today I have a lot of wonderful material from the KCM blog. I want to give them credit because they do a wonderful job organizing some of this information. Probably there's just hot off the presses in the last couple of days, something which even more than interest rates would give people cause to think about, gee, I probably need to be thinking about finding a home now versus later. And that announcement had to do with Freddie and Fannie. Now, Freddie and Fannie, you probably have heard those names, but just in case you haven't, or you have, but you don't know exactly what they are the Fannie Mae and Freddie Mac are the government-run agencies that have propped up a troubled real estate market over the last several years. The agencies always had a place within the mortgage sector, but over the past several years have been involved in over 90% of new mortgage originations. So what was announced, and I quote here President Obama actually from August 6th, the good news is right now there's a bipartisan group of senators working to end Fannie and Freddie as we know them. And I support these kinds of reform efforts. And what does that mean? Well, it means that the government is looking to the private sector to take over the role that Fannie and Freddie have been playing. So how is that going to impact any of us?
Before we get to that part, Richard, let's also let people know that Freddie and Fannie have not been part of the government in the past. They've been government regulated, but they have been separate private organizations until our crash in 2008 happened, and the government felt they had to kind of step in to stabilize things more.
Good point. Yeah, good point. Thanks for clarifying that, Tom.
And they've always played a significant role. In fact, it's they're two of the agencies that have helped to ensure loans for the banks that have been the ones who've directly made most of the loans historically. And by giving those guarantees, they've allowed the banks to have less risk and therefore make loans that were more attractive to buyers, but less attractive from a return on investment standpoint.
Yeah,
we saw what happened with that.
Yeah, so you have to assume, therefore, that almost in any future model being drafted, loans will be more expensive.
Mm-hmm. Because they've been subsidized in the past.
Yeah, so that's going to be felt in two ways. Certainly higher interest rates. According to Mark Zandi at Moody's Analytics, the obvious question, it will mean higher mortgage rates. The question is, how much higher? Also, and something that people probably had no concept of this, I certainly didn't, I hadn't thought about it until I read this, is there will be loan terms that are going to be shorter. The 30-year fixed may well become a relic of the past.
Which many people, I think, don't realize that in many parts of the world, the concept of a 30-year fixed rate is a foreign concept, if you excuse the pun.
Well, not only that, but in Canada, right next door to us, we can certainly relate to them. We have so few differences, but in this regard, it's quite different. In Canada, they don't even have 30-year fixed mortgages available. The vast majority of Canadian home loans have a 25-year payout, with the interest rate being renegotiated every 5 years. If rates go down, the borrower will end up with a lower rate. If they go up, he pays a higher rate.
And in a capitalistic world where you have just private industry involved, who in the world would want to take on the risk of predicting where an interest rate is 30 years from now? So unless you have a government that is basically guaranteeing and subsidizing loans, it's hard to imagine anybody, any company wanting to project that. What major corporations even project where they're going to be more than 5 years from now?
Yeah, exactly. And in the case of Canada, again, if you want a fixed rate mortgage for the 25 years, you have to pay a rate approximately 2 percentage points higher than the going rate at the time of your closing. So let's face it. The availability of the longer term loans are going to probably change. It's going to be more expensive because of higher rates, and the shorter terms means you can't rely on that 30-year cushion.
Now, as a side, I might mention, maybe I've probably referred to it at some broadcast in the past, but 2 years ago, acquaintance of ours, Dr. Doug Duncan, chief economist at Fannie Mae, invited a few of us back to D.C., Sean O'Toole and Bruce Norris and Howard Blum, and I went back there to talk to them and present to a group of folks they got together why the investors should play a larger role in absorbing this inventory. And I found it very interesting that at the time we were there, so that's what, 2 years ago, a little over 2 years ago, and it was seemed to be pretty accepted and standard knowledge within Fannie Mae that they knew they were going to be out of business one day, and they already had the mandate that they were supposed to shrink themselves by 10% a year and be gone in 10 years. So it was not new information. We just have other folks, I think, rattling the sabers and talking about it. But I think as much as I would like to see, and I generally prefer free markets, given that they're there at this point, I would think that it would probably be best if we phase them out rather than just chop it off tomorrow. Or that would be catastrophic.
That's for sure.
Yeah.
That's for sure. Well, let's talk a little bit about where our values are headed. We talked about the cost of money. This is a survey that was just completed called the Home Price Expectation Survey, and the company that does it is Pulsenomics. And the latest survey released last week, here are the results. Home values will appreciate by 6.7% in 2013. The average annual appreciation will be 4.7% over the next 5 years. The cumulative appreciation will be 23.7% by 2017. And even the experts making up the most bearish quartile of the survey still are projecting a cumulative appreciation of over 13% by 2017. So any way you look at it, homes will become more expensive. Obviously, inflation is a big factor, and a strengthening economy adds to that. So you want to buy now, certainly, if you want to get the lowest possible price in preparation for the price appreciations that are going to occur in the future.
So from the different resources you're looking at, what's your take on it? That prices on the average across the country and even in California will continue to go up for a while, but we have it'll just be slowing down.
Yeah, we definitely see a long-term trend of going up. That doesn't mean there won't be some corrections, and corrections are often healthy. In fact, I was watching an interview on TV the other day from someone from Merrill Lynch pointing out that they are definitely predicting rising markets with the obvious occasional correction, which is, again, healthy. So I don't think there's any way to avoid it with inflation, with an improving economy. And I look here in Silicon Valley, which obviously is a little different than many other areas in the country. We're very fortunate to have an industry that is very dynamic, and we're finding that companies are moving into Silicon Valley. For example, this might surprise you, Walmart.
We'll be back with
a research and development group right here.
All right, I'm sorry. We'll got to take a break here. We'll be back in a moment to continue the discussion with Richard Crouch. This is KDOW 1220 AM. We'll be right back.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. We're have back with us today Richard Crouch, who's a realtor with Alon Pinnell Realtors and also investment advisor with Transamerica Financial Advisors, and another entrepreneur turned real estate professional who watches the market and helps us interpret it. And we're chatting today about the dynamic market that we're in, what changes are going on, and where things are headed. So, Richard, let's we wrapped up the last segment there talking about home values appreciation starting to slow down a little bit, but that doesn't mean that the bullet train has stopped. It's still moving, and let's go talk about mortgage rates some and its correlation with home values and sales and so forth.
Yeah, exactly. And the other thing to keep in mind, I tell people this all the time, is that even though the market slows and there's less buyers perhaps or less offers on a house, that doesn't mean the prices go down. They're still going up. They just don't go up as fast. So some interesting perspectives here on rising interest rates that I have to share with you. These come from several sources, the first of which is Zillow, the website that most of us probably have interacted with at one time or another in the past, with lots of information, some of it challenging. But nonetheless, Dr. Goodell there, one of their senior economists, said that as long as mortgage interest rates don't rise too far and too fast, most markets should be able to absorb these changing dynamics while still remaining healthy. So that's encouraging. From Fannie Mae, Doug Duncan, your associate and friend, Tom, chief economist and senior vice president of Fannie Mae, consumers have taken the interest rate rise in stride. Expectations for continued improvement in housing persist, and sentiment towards the current buying and selling environment is back on track from its dip last month. These results are consistent with our own analysis of previous housing cycles, which finds that interest rates and home prices are not strongly correlated.
Which I find shocks most people. I'm amazed at how, and I guess it's somewhat maybe intuitive, but a lot of people think as soon as interest rates move a little bit, it's going to just shell shock and stop the entire market. If you look back even in days of Carter years when we had high double-digit numbers, the market was still pretty brisk.
Yeah. Let me mention something here from Chulia, their chief economist, Jed Coco. If you were worried about a housing bubble, July's asking price slowdown will probably be the best news you've heard this year. Yeah. The asking home price slowdown in July could be the start of the return to normal price gains. The blazing fast-paced increases we've seen in recent months could not last, especially with rising mortgage rates, expanding inventory, and declining investor interest.
I think the main thing that the interest rate does as it goes up is it affects the affordability index slowly, but with time, when that affordability index gets down low enough, then that signals we've hit a ceiling again. But
you bet.
I don't think we're on an average. I don't think we're quite there yet.
Yeah, no, exactly. So a few comments before the break about shadow inventory. What is it? Well, this is the overhang of distressed properties, whether foreclosures, people with 40, 90 days behind on their mortgage payments, properties that have already been foreclosed and owned by the banks. What's the impact? What's been happening? Okay, the great news, the inventory is down 18.2% from the same time last year. Foreclosures down 27%, national foreclosure inventory down 29%, and seriously delinquent loans, most importantly, are down 22.7%. Last couple of points here. How does this all compare to the norms? Though they were approximately 1.4 times what they were on average during the 1995 to 2005 period, delinquencies have come down significantly. As fewer problem loans are coming into the system, the inventory are working their way through the pipeline. New problem loan rates are now at just 0.73%, which is right on par with the annual averages during 2005 and 6, including extremely close to the 0.55% average for the 2004 period preceding.
So we still have a significant shadow inventory, but it's coming down as some of these loans are getting worked out. We have the bottom end of the time of the market that's underwater is getting less and less with time. We have with us today Richard Crouch, an investment advisor and realtor with Lon Pennell Realtors, who's helping us decipher what's going on with this marketplace that's so dynamic. And this is KDOW 1220 AM. Tom Wilson, Real Estate 360. We'll be right back.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Well, we have with us today Richard Crouch, who is a realtor with Lon Pennell Realtors and investment advisor at Transamerica Financial Advisors. We're discussing the dynamics of this changing marketplace, and in the last segment we were just discussing about the shadow inventory, the fact that it has been reduced somewhat because we have the prices rising and it erodes the bottom end of the upside down market somewhat, and the foreclosure rate is dropped, but there is still a large shadow inventory, so it's still going to be a while before all of this negative equity gets wiped out. So we've been talking kind of nationally. Let's chat for 2 or 3 minutes here on just some examples of what's going on in the Bay Area and Silicon Valley, Richard.
Yeah, and I've got some statistics from Santa Clara County. I want to comment that the entire Bay Area has been getting better and better in every category, as well as Santa Clara County. Santa Clara County, I think, is a little bit of a bellwether, largely due to the presence of Silicon Valley, and so I'll have some distinct numbers on that. If listeners would like some distinct numbers on the other Bay Area counties this week, feel free to contact me at richardandcandace.com. And so let me start by just saying that mortgage closing costs are rising also. And that's something that many of us don't think about, but they actually went up 6% over the past year. And why are those fees rising? Well, the low and rising mortgage rates and then new regulations. So that will become a little clearer as we go forward. One of the aspects of the regulations are rising costs to the consumer. The Financial Protection Bureau and its new mortgage regulations to protect people. We've all run into this. Significantly enhanced underwriting has been brutal at times for all of us. In any event, despite all that, here's some trends for Silicon Valley. Between July of 2012 to July of 2013, the median price, July 2012, was $690,000. And it went in June to $816,000 and then to $840,000 in July.
And this is Santa Clara County, Silicon Valley, right?
Price.
Yep.
The average price, which is a little bit more meaningful to the average homeowner, in July was of 2012, $909,662, up to $1,028,130 in June of 13, and $1,052,610 in July of 2013. So trending big jumps. Home sales have gone from 1,059 up to 1,000, actually gone down a little bit to 1,052, and that's because of the lack of inventory. The pending sales are also down because, again, the volume is down. We're at 1,772 a year ago and 1,284 now. This past month in July. And then inventory, 1,362 in July of 2012, and now 1,433. But what's important to understand is going back to January, February, the total inventory in Santa Clara County was only 750. It's now 1,433, and what is considered normal is about 2,500. So we still are limited on inventory.
All right, and and it should be noted that times that have been difficult in the past, we've seen as many as like 5,000 in Santa Clara County. So that's a huge variation. We have Richard Crouch with us today, Lon Pennell Realtors realtor, and he's a entrepreneur turned real estate professional. We'll be back and discuss more about what's going on in the marketplace on KDOW 1220 AM. We'll be back in just a moment. Stay with us.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360Radio.com. That's RE360Radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
We have Richard Crouch with us today, one of our frequent guests, talking about the dynamics of this real estate market. We're talking about the Silicon Valley stats and how things are slowing a bit, but still going okay. And let's talk a little bit about the unique demographics of boomers and seniors and how that's is and is going to affect real estate, Richard.
You know, it's an interesting story. It's something that I've been thinking a lot about, and it's something which is upon us, and it's something it's a good thing, but it presents its own needs for support on the part of boomers and seniors for what they want to do in the next 10, 20, 30 years. Let me just read something from a recent AARP study revealed that 80% of adults 45 and older believe it is important to live near their children and grandchildren. These are the same people that raised their kids, paid their home off, and rewarded themselves by moving permanently to a climate desirable part of the country. Then something happened on the way to the country club. The cell phone rang, and news arrived that soon a grandchild would enter their lives. As the AARP study indicated, this often creates the desire to move back closer to kids and the new grandchild. Now, I've been telling people time and time again that there's a lot of people out there, and we know that the number of baby boomers is something in the 60 to 70 million when the whole 1946 to 1964 people in that time frame.
And that's just the U.S.
Yeah, that's just in the U.S. That's right. That it's the single biggest demographic, which not only will businesses focus on that demographic for future sales because they've experienced that in the past with the people that were born after World War II, et cetera, et cetera. But there's going to be a tremendous movement as people downsize. The house they have is too big. As they right size, the house maybe is too big, maybe it isn't, but for them they want to have a different style of home. And then they just want to move because they do, in fact, want to be close to their family, their children, as they get older. A very natural thing, and it happens all the time. So we're seeing evidence of this, and many of these people have their own homes, most do, and they also have, in many cases here in Santa Clara County, in other counties across the country, no doubt, but perhaps not quite the number that we have here, who own residential real estate properties. And what they're trying to do is to simplify their lives going forward. They want freedom from any obligations and responsibilities, whether that be their children or perhaps just the fact that they have a real estate rental property business that they really don't want to have to worry anymore about tenants, whether they pay the rent or not, depreciation of the properties, or what is the value of that real estate portfolio going to be in the future. A lot of question marks there. And then they also realize that they've got all their eggs in one basket. In other words, all of their equity is in real estate. And that, when you get into the years of retirement, you want to have fixed income investments where you know what your wealth is going to be without any doubt whatsoever. And that's what you need in order not to be worried constantly about the future. So for boomers and seniors, there's a number of entities to help. One category is called professional organizers, and they do just that. They help people figure out what to keep, what to ship, what to store, what to dispose of, what to sell, and what to donate, and what to take to their new home. There's also senior move managers. Because children are spread out all over the country these days, they don't really necessarily have their children to help them do a move, and it can be a major ordeal. Thirdly, an obvious one, they need a realtor because they may be selling their own home, they may be selling some rental properties, and all this may be in a phased process, not necessarily all at once. And the real estate agent that they pick needs to have alliances with the professional organizers, the senior move managers, and, of course, to have experience with boomers and with seniors. One of the designations, which is a national search capability for a seniors designated agent, is SRES. That's Sierra Romeo Echo Sierra, to help you find people with the expertise that's relevant to this group. And then finally, to have access to someone that can help them figure out what to do with the assets when they sell, how to reinvest them, how to make sure that they're safe and that they can count on those assets for the rest of their lives.
Gosh, I don't know if I want to become a senior. It sounds like a lot of things to do.
It is a lot of things
well,
to
we
do.
wrap up. We just have a minute. Wrap up this segment. While we're talking about demographics, let's just make a couple comments briefly about the Hispanic population and what their impact's going to be.
And let me just quickly say, and I want to do that right now, just that all of these things are pretty complex. If you want more information or help, I'd be happy to talk to you and help you, point you in the right direction wherever you may live. So feel free to contact us through our website, richardandcandace.com. So on the Hispanic side, it's something which all of us know. It is the fastest growing group in our country and is a big asset to this country. What we don't understand really well is some of the statistics. Upscale Hispanics and those who make $50,000 or more a year will generate 37% of spending power in 2013.
Is that nationwide or California?
And that's nationwide.
Nationwide. Wow.
Yep. And that's about $500 billion out of a total of $1.3 trillion in the country. And that segment is expected to double again by 2050.
Wow.
That's long before we're all gone.
Richard, we're going to have to break here for a moment, but that's
Okay.
a pretty significant factor that we I think people should consider when they're looking at their investments. Got Richard Crouch with us today, our entrepreneur from Silicon Valley turned real estate professional, who's helping us look at the market. This is the Wall Street Business Network with KDOW AM 1220. We'll be back here in just a couple of moments to come have a couple of wrap-ups.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Boy, what a dynamic market we're in, and so great, Richard, to have you with us to help us interpret this. I know you read a lot of material. No one person knows what's going on all the time, but if you read a lot of material and put it together, I think helping to summarize it and go through it is a big help. So thanks for being with us. We've got I think some things that are important for the listener to consider is one, all the economists that, with rare exception, that I respect feel inflation is inevitable. And you want to be in assets that hedge against that. Certainly real estate is one, so real estate investments are still very important, very good. I think with things slowing a little bit but still pretty hot, it means that we don't have quite as many multiple offers, and it's a little bit easier for a buyer. And if a seller sitting on the fence thinks since things are slowing a bit, I would say don't sit on the fence anymore. Let's get moving and get that property listed and sold before things do slow a little bit more. So it's still a very dynamic market, and usually inaction is generally the worst thing that I believe people can do.
And Tom, talking about inaction, I mean the biggest benefit of reducing inaction is getting more inventory out there, because without more inventory, buyers can't buy.
Yep.
And they may not have a choice of not being able to buy until the expenses and the prices have gone up even more. And that's what I think most people are really concerned about right now.
Yep. Richard, if people want to get some more information from you, how can they reach you?
Okay, well, the website is richardandcandice.com, and that's Candice is Kandis, so richardandcandice.com, and the phone number is 408-391-1231, 408-391-1231.
Rich, always great having you with us. Thanks for being on the program today.
It's a pleasure, Tom. I really appreciate it.
And we, again, if there's on TomWilsonProperties.com, it's a great resource for education for the real estate in general, especially real estate investor. If you would like to have see a little summary once a week of what's going on in economics in the country and world as it affects real estate, that's a very nice summary. If you want some information on how to select a place to invest in, a metro and a product, we have a report, 19-page report that you can request, again, by going on that website and contact us. And that will be a nice methodology and approach on how you find out where you want to invest. And I think there's no better time than now to build up for your retirement and get some assets that will hedge against inflation. So we've talked today about where things are going, what the government's impact is, and a little bit about what's happening here locally in the Bay Area. But we try to give you information that applies to no matter where you are. So nice to have you with us. Please be back with us next week and every day of the week. And this is Tom Wilson on Real Estate 360, KDOW 1220 AM. Nice to have you with us. And remember, the only thing that matters is what you do next. Nice to have you with us. Bye-bye.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit RE360radio.com. That's RE360radio.com. AM 1220 KDOW.